Thank you so much for joining us. I'm Ashley Evans. The question on everyone's mind is, will the Monetary Policy Committee cut interest rates this year? Do uncertain times call for a measured approach to risk? Joining us is Henk Kotze, who is a portfolio manager in the interest-bearing team at Prescient Investment Management. Henk, thank you so much for joining us.
Morning, Ashley. Thank you for having us.
So will we see interest rates cut this year?
Actually, from our side, no, we don't see that happening. Why do we say that? So on the one hand, if you think that the MPC is serious about getting inflation expectations down to 4.5, which is the midpoint between the 3 and the 6 target band they have, then they can't be seen to be cutting rates in that scenario. Traditionally, the expectation for inflation has been between 5 and 6, or the upper end of that range. That's creates a self-fulfilling prophecy for inflation being a bit higher than what they would like to see it. And they're really strongly indicating that they want to get it down to 4.5%. It's important to make the distinction between inflation expectations and actual inflation. It's the expectation of inflation they're trying to get down to 4.5%, and for that reason we don't see them cutting interest rate in this scenario.
Load shedding and the water crisis as well has obviously been a drag on our economy. What is your view on how much of an effect this will have on our fiscus?
It's a good question, Ashley. From our side, we do think that load shedding is going to have a bigger impact than what the market actually expects and what we see. We see it as a very big drag on growth. I think we can park the water for now. I think Eskom is the main concern, and it's also probably the more pertinent concern. We've seen load shedding moments happen where we haven't seen a load shedding moment for the water industry. But yes, we see it as a very big drag on growth. It is a big problem. It's something that we'd need to fix in the medium term to get growth back to anywhere close to where we should be growing.
And how do we fix that?
That's a good question again. So we've seen the ANC and the government have plans to try and break Eskom up into 3 different departments or 3 different companies, so transmission, generation and distribution. I think that's a good step in the right direction. Downsize the problem to fix each of the different drivers, but it's going to be interesting to see how they take that from here. It's not an easy solution. I think if there was one, we would have seen it by now, so we will have to give them time. Hopefully we have enough time for them to fix this, but we are running out of time.
What are some of the other macro factors that are supporting this case for maintaining these interest rates?
So from our view, I think that in emerging markets, you want to be seen to be competitive from an interest rate perspective. So cutting rates, if there's a shock in emerging markets and you're not as competitive from an interest rate perspective, we'll see money flowing away from South Africa to other EMs. And that would unfortunately also be destabilizing in our financial system. The government, we're not seeing enough foreign direct investment, so what we would call sticky money. And we're funding our deficits through fast money or portfolio inflows, that's buying our bonds for the yield they generate. If we're going to cut interest rates, bonds become less competitive. That creates a destabilizing problem for the Reserve Bank and for money coming into South Africa. And we really do need the portfolio flows to fund the deficit we have.
In your opinion, would cutting interest rates stimulate growth?
We don't think so. Why do we say that? So interest rates are still traditionally quite low in South Africa. We don't see the problem for growth being from high interest rates. We see it from more policy uncertainty and some structural issues we have within South Africa. So cutting interest rates in that scenario wouldn't necessarily have the desired impact or effect that the MPC would like to see. I think we have other structural issues we'll have to fix before cutting interest rates will have any sort of material impact. We also haven't seen really a big hiking cycle in interest rate in South Africa because of the growth story. So we don't have the growth to raise the rates, so we don't really have the scope to again bring down the rates to stimulate growth.
Let's dive a little deeper into what really needs to be addressed in order for us to see real growth.
Yes, I think the one key message and one key thing that we need to fix is policy certainty. We need the government to come out with strong statements, fixing labor issues they have, making we've seen the mining charter being a bit more clear on some of the pertinent issues. They need to be more sound on that, give us policy certainty, put the land expropriation debate to bed, give foreign investors reason to come back to our market, local corporates, give them the confidence to invest in South Africa. If we see that policy certainty, all the other cogs of driving growth will fall into place. We have a lot of cash that can be spent. We have the necessary know-how. We're very robust entrepreneurs in South Africa. If we see policy certainty and we feel our money is going to be put to good work, we'll see the growth come back.
In a perfect world, obviously we'd like this to happen this year, but realistically, what are we looking at?
So I think let's get the elections out the way. So that's the next sort of big uncertain event to happen. If the ANC gets strong mandate, I think there's really good scope for them to start implementing these stronger, more clear policy directions. I think we should call it the medium term. If we get these things right in the medium term, there's some low-hanging fruits which we can pluck, but we definitely need these things to come through in the medium term. It's definitely not a long-term thing, and we don't have that much time. Our deficit keeps widening. Our debt to GDP keeps ballooning. We already, as we know, junk rated by 2 of the rating agencies. The other one's on the cusp. They've given us reprieve again, but how long? So I think it's a medium-term problem. We need to fix it. Post-elections, the government comes in, makes some strong statements, and let's hope for the best.
In today's economic climate, how can one best position one's investment portfolio to obviously have optimal growth?
We at Prescient believe that you shouldn't be too pessimistic. We always try and sketch the image for our clients of the South African environment being one of a glass full of murky water. So it is fairly difficult to navigate through that, but we do also see the water that's running into this glass being clear. So the more we have certainty coming into the glass, the more clear it becomes. We will see great opportunity again. And in that vein, in the short term in South Africa, we have great real returns. At Prescient, we believe that why do we invest in fixed income instruments or fixed income investments? It's to generate a real return or beating inflation. At the moment, we're lucky in South Africa. We have a good interest rate. Inflation is fairly well contained, so you're generating great real returns, and it's not something you must take for granted. It's an opportunity to be taken, and I think you must capture that opportunity. Be conservative. Do what you know you do best. Stick to your process, but capture those real returns.
Great. Thank you so much.
Thank you for having us.